The market crash is inevitable. It's imminent. It's almost here. Just wait one more second. That's been said since 2015. For 6 years, we've been hearing the same tune being played about the market about to crash. However, in hindsight, that is as good as the weatherman on TV. It's very funny, very entertaining, but rarely accurate, and nobody gives a crap about what the weatherman is saying. We all make our own decisions. Now, the market not only not crashed in the past 6 years, it actually ballooned. For the past 2 years, which included a pandemic year, or maybe even a two, the S&P 500 did a whopping 45%. So the market is doing better than ever. Now the question is this the year? Is 2021 the year where the market actually crashes? However, unlike the past 5 years, this time we have some heavy hitters on both sides of this argument. On the one hand, we have Michael Burry talking about inflation, hyperinflation, a market crash. On the other hand, we have Cathie, the Tesla god, basically talking about deflation and how inflationary concerns are irrelevant. And in this video, I'm going to test both of these arguments to tell you whether I think the market crash is imminent or it's not. Essentially, this is going to be a battle between Michael Burry and Cathie, which is something we all want to see but can't get. This video is going to be the closest you can get to it. So what I'm going to do in this video, I'm going to show you 5 arguments why the market is literally about to crash tomorrow. It's inevitable. But just to screw with your head, I'm going to show you 5 arguments why the market is not about to crash, and this is all FUD and pretty much a joke. Stick around, this is about to get bumpy. Now, the one reason I'm extremely excited to make this sort of video is because unlike 2015 and onwards, this year we have some extra argument and extra circumstances to make it interesting. This is not just about overvaluation of the market. There's other factors in play here, which makes this into a very interesting debate. And since the person I like to debate the most is me, I'm gonna do the debate against myself, but at the end of the video, I'll give you my own conclusion who I think is right, me or me. In any case, I win. So the only thing I ask of you is don't click nothing, don't smash nothing, don't buy nothing, don't subscribe to nothing. Just stick around with me, give me your attention, and I promise to give you a really good time for the next 5 to 7 minutes. So let's start with the first 5 arguments that a market crash is inevitable and is literally around the corner. The first argument is inflationary, and I have a scientific name for it. It's called the money printer goes brrr. Essentially, this argument is saying that the Federal Reserve and the US government have provided so much liquidity being cash to the market, and have lowered the interest rate to zero, essentially discouraging any type of savings, that now this money went straight into the stock market, straight into commodities, straight into raw materials, made everything expensive as hell, and due to the snowball effect of this whole thing actually feeding itself, we are now headed to inflation, probably even extreme inflation, and we can't do nothing about it until we raise interest rates. And when we do that, we're going to crash the stock market, because what happens when you increase interest rates, essentially the DCF valuations of all these companies, especially the companies with future profits, actually go down. Basically, inflation is going to lead to higher interest, which is going to lead to lower prices of shares, essentially crashing the stock market. Let's move on to argument number 2. So the second argument also has a scientific name, and it's called shit are expensive. If you take a look at the Nasdaq 100, which is an index that lets you see what's going on with the large cap profitable tech stocks, you'll see that the price to sales average is about 6 or almost 6, which is double than what we had in 2015 and is almost at the 7 level. 7 is the highest we ever had, and that happened, you guessed it, during the dot-com bubble. So the argument here is that we're nearing the stage where the stocks, the tech stocks, are going to be so much overvalued, it's going to be a replay of the dot-com 2000 crash. Let's see. The third argument is called Warning Buffett, and it has to do with the Buffett indicator. Now, in case you didn't know, Warren Buffett is such an OG, he literally has an inflationary indicator named after his own legal name, which is something I'd love to have one day, but I doubt it, the Nash Indicator. Well, we have the Nash Equilibrium, but it's not mine. And on a serious note, this indicator has another name. It's called market cap to GDP. Market cap being the total value of stocks right now in the stock market, and the GDP is the gross domestic product. Essentially, the total value of all the services and products we're producing, essentially the comparison between the value we're generating as a society versus the prices of the stock of the companies that generate that value. We want to see how much they're overvalued versus the produce that they're actually producing. Now, right now, the ratio is, get ready, 207%, which means it's twice overvalued. It's quite heavy. Now, if you take a look at the chart and you actually zoom out, when in doubt, zoom out, you'll see that the chart actually spiked right around 2019. Q4 2019, it crossed 140%. Ever since the dot-com crash, we've been below that ratio. And in Q4 2019, we started crossing it, and now we're parabolic. We're at 207%. This is unprecedented. The price of the stock compared to the actual value of goods and services that we're providing right now as a society is twice as expensive. That's not a healthy situation, and that's not a sustainable situation, and a correction has to come. The fourth argument is called show me the money, another scientific name, I know, and it has to do with the amount of IPOs, initial public offerings, that we had in the past year. We're at 900 right now. $200 billion raised in the past year alone from 900 IPOs. Just as a comparison, the highest year we had so far was in, you guessed it, 2000 with 600 IPOs, which is another indicator that the market is literally going crazy and the correction has to come, much like it happened in the 2000 dot-com crash. It is what it is. And argument number 5, I call, you scratch my back, I scratch your back, you pay me 0.05%. Now, it actually has to do with the reverse repo market. A reverse repo is, in case you haven't watched my video on it, essentially it's a situation where the banks park their money overnight with the Fed, because the banks can't hold too much money, because a bank is not like a human being or a company. Cash is a liability for a bank. It holds cash in a cash deposit for someone else. So it's a liability for the bank. Banks have to be balanced. They can't hold too much liabilities. And overnight, in order to actually balance their book check, they give the Fed some of the money and they receive collateral. And in the morning, they take it back. It's a very simple instrument just to keep the banks balanced. And it's a really good indicator to what's going on in the market. Right now, we're almost at 900 billion. Just on April, 3 months ago, we were at $31 billion being parked at night by the banks. Right now, we're at 900, almost at $1 trillion. That means two things. Number one, the banks have a lot of cash that people have put in cash deposits, meaning that the money printer goes brrr, generated a lot of cash, and now you see the results. The other thing is that the banks see no opportunities outside to actually invest this money. They literally are willing to take 0.05% overnight interest just to keep the money. They can't find any decent investment outside because shit are expensive. Stocks, real estate, everything is just way too expensive. So they rather just park their money and get it back for literally nothing, or at least almost nothing. That's a really good indicator of inflation. And now let's talk about counter arguments. And yes, I've changed angles since I'm debating. So the first argument has to do with the 10-year bond. Essentially, the 10-year bond is a debt instrument issued by the US government, and this is widely considered as a really good instrument to measure what the market is thinking about inflation. If you watched my previous video about that, you know that the prices are negatively correlated to the yield. It's like a car. The cheaper you buy the car, the more value you're getting, right? The better deal you're getting. The same thing with bonds. The cheaper you buy it for, the more yield you have. And demand plays a huge part in that. So if the demand is shit, the prices are actually going down, the yield is going up. Right now, the yield went down by 22.5% in the past 2 months, meaning the demand went up by 22.5% in the past 2 months, meaning the market is thinking that over a course of 10 years, that whatever 2% this thing is paying is going to be enough to cover inflation. Now, counter argument number 2, I call the Cathie Wood argument. Essentially, this is basically saying, well, yeah, Warren Buffett is right. Market cap to GDP is very high. But that's justified. The disruptive power of these technological growth stocks we're dealing with right now, the Palantirs, the Teslas, they're so big that this price is justified. They're about to change the way we do business, the way we live, and that's why we're pricing in all this future disruption into these stocks right now. It's not overvalued, it's just priced right. Again, it's a matter of opinion. If you're Cathie Wood, you agree with it. If you're Warren Buffett, you're probably laughing your ass off. Whatever it is, you decide for yourself. And speaking about Cathie Wood, let's talk about deflation, which is the third argument here. Essentially, this argument is basically saying that a company like Tesla is going to take the lunch of existing legacy automakers and basically cause a deflationary impact to the market. Now, that's a lot of high words. What does it actually mean? It's actually very simple. Let me explain. Let's say that at a certain city, Tesla is going crazy. It's actually outselling the Chevy cars completely. And just using Chevy as an example, not specifically saying anything about Chevy. But bankrupt. And what will happen in this hypothetical case, and of course it is hypothetical, what will happen is that a lot of these existing dealerships will close because Tesla, that took over a lot of this market, is now not utilizing the whole dealership structure because they sell direct to consumer. So you have a lot of growth actually taken into negative because dealerships are closing, people don't have jobs, and a lot of this growth is actually tamed by the deflationary impact of Tesla. Now, Tesla is just one example. She's saying that about her entire portfolio. She's basically saying, well, our companies are so destructive, they're going to put a lot of businesses out of business and cause a deflation, which will counteract against the inflationary impact that we're seeing right now. Matter of opinion. Now let's talk about item number 4, and that I call the oil honey trap. Essentially, this has to do with the oil manufacturers, the oil producers. I don't know if you call them manufacturers, they're pumping shit out of the ground, but whatever. They're stuck in the golden prison. Essentially, they're like the legacy automakers on Tesla. They have to pay Tesla regulatory credits just to stay in business, but by doing so, they're killing their own business. It's the same thing with oil. The oil producers have to keep the price at about $70 to $80 just not to go broke. The problem is with keeping oil prices so high, they're pushing people into renewable energy. And when I say people, I mean whole economies, because when oil prices are so high, it's a negative incentive to use oil and a positive incentive to use renewable energy, like solar panels, like driving a Tesla. A lot of things are happening that are deflationary because the oil producers are keeping the price high. They're essentially screwing themselves, and they have no choice because they have to basically make a choice, either die now or die later. Essentially, they're taking as much profits as they can right now because they know over the course of 10, 15 years, they're pretty much done, much like the legacy automakers. The fifth argument I call the Jerome Powell argument, the transitory inflation. So you remember how a while back the lumber prices spiked and then they came down? And what Jerome Powell is basically saying, hey guys, what you're seeing right now is not inflation. You're seeing supply chain interruptions. Not enough people to produce, not enough people to distribute. We basically have a shitstorm on our hands. We just spent a year in lockdown. It's going to take time to produce, to go back to production capacity, to distribution capacity. And you're going to see temporary issues with certain raw materials and commodities. And when we go back to full scope of production and distribution, this will basically go away. That's the argument here. And now it's time to the conclusion. Who won? Me or the other me? So what do I think about this? Well, I think a lot of these arguments are very interesting, and I'm not going to be sitting here saying that I'm a prophet that knows everything. But here's my opinion. I think that the biggest problem that we can't counter argument against is the supply of money that increased insanely. The 0% interest that we cannot raise without completely crashing the market, basically putting us in limbo. That's my biggest concern. Some of these shortages in the market right now may be temporary. Technological stocks may be properly priced in certain companies like a Tesla or a Palantir. True, these whole arguments make a lot of sense. Yes, bond yields are going down, for sure. But here's the thing. I'm more closer to Michael Burry than Cathie Wood on this because I think that inflationary impact is inevitable when you have so much money in the system and so little incentive to save because the interest rates have to stay at very low levels. Essentially, what you have right now, and it's about to get worse, is that everybody's driving a Lambo right now. The gardener, the pool guy, the bartender, all driving Lambos and Ferraris. There's so much free money in the market right now, basically pushing us on the brink of inflation or even severe inflation. I don't agree with Michael Burry that it's going to be hyperinflation, but I think we're actually headed to highly inflationary times, stagflation, and a lot of issues that we have to resolve and have not been addressed yet. And I think that will lead to a market crash in late 2021, early 2022. But again, it's just my opinion. I'm not a financial advisor. I'm just a guy on the internet. You have to do your own research because this might be inaccurate. This might be wrong. These might be the ramblings of a madman. Who knows? Blah, blah, mother effing blah. I appreciate you spending this few minutes with me. Thank you so much. A huge shout out to the channel members and the patrons. I love you all. We'll see you guys in the next video.